Hi there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Arvind Narayanan, the lead portfolio manager for the Vanguard Ultra Short Bond ETF, ticker symbol VUSB. Arvind, welcome to the show.
Thanks, Sumit. Great to be here.
So Arvind, tell us about VUSB, the ETF that you manage. What's the investment strategy of this fund, and how does it compare to other short-term bond funds from Vanguard, like your money market funds and things like that?
Sure. VUSB is the Vanguard Ultra Short-Term Bond ETF. So in this strategy, we really look to invest in the what we would determine to be the ultra short-term bond space, which means anything from 0 to 2 years of maturity spectrum is what we try to invest in. We target a duration profile of about 1 year for this fund. So that's important. That's an important differentiator for this fund in a couple of different ways. Other ultra short products in the marketplace typically target a 3-month duration. We believe that our product is differentiated because we target around a 1 year duration point. And why is this important? Is because we seek to invest in credit, primarily high quality investment grade credit across multiple different asset classes to generate additional income over and above the 1 year treasury bill. This helps the fund from a structure standpoint a couple of different ways. Typically, when credit spreads widen out, you typically see interest rates rally along with it. And so you have both those levers of, if you will, within the investment profile of the fund of having credit spread exposure and duration exposure counterbalance each other in periods of stress. So that typically limits the downside performance of the fund relative to some other strategies. At the same time, because we are taking credit risk in the strategy, this fund is different from a money market fund. In the money market fund, is primarily government risk, and you have a dollar NAV on money market funds versus a floating NAV on the ultra short-term product. And so you do have some NAV variability, but for that, investors are getting compensated additional yield through investments in credit and have the downside protection of having a small amount of duration exposure that should help investment performance in periods of stress.
And can you talk a little bit more about that, Arvind? How much credit risk is the fund taking, and how much extra yield can you get by buying something like this versus, say, a Treasury-only ETF? Some people have noted that you're not getting paid a whole lot extra for taking credit risk in the current environment. Would you agree with that?
Credit spreads have compressed for sure. So that's why we like this product because it's an actively managed product. So and this is supported by the exact same team at Vanguard that supports our entire active fixed income franchise. And so we leverage the depth, the experience of the whole team to manage our exposure in credit, manage our interest rate exposures, and to ensure that we deliver returns for our shareholders in this product. When you look at a comparable treasury fund, our goal is to generate an additional yield of about 50 basis points running over the course of a full cycle. And so you can expect, investors can expect to earn about 50 basis points more in this product relative to a similar duration treasury-only fund. So the credit exposure gives you that additional income and performance. And because it's an actively managed fund, we get to use our resource to determine when is the appropriate time to dial up and down the level of credit risk we're taking in the fund. And it's important to note that as we invest in credit in this strategy, it is predominantly high quality investment grade credit. So investment grade corporate bonds, structured products, the senior parts of the structured products universe, such as consumer ABS, some agency mortgage CMOs with really tight durations, some very high quality sovereign debt. So that is the types of investments that you will see in this portfolio. We do not seek to invest in below investment grade bonds in this portfolio or really esoteric securities. In addition, we have very strict guidelines around the concentration within each of the securities that we invest in the portfolio. We also have strict guidelines around the ratings quality that we invest in. While we invest in investment grade broadly, we still limit the amount of triple B exposure in aggregate at the fund level to ensure that the fund has that high quality tilt to it. So we have a lot of very actively managed risk parameters around the guidelines on how we want to approach investing in the fund. In addition to that, we really use all of our experience and expertise in navigating what the credit markets throw at us.
That's great. And it does seem like there's been some strong demand for this ETF. I'm looking right now and it has over $4 billion in assets under management. Before I let you go, Arvind, can you tell us how this type of ETF fits into a broader diversified portfolio? Who should consider investing in this fund?
Absolutely. When I look at the use case of this product, it's really has a couple of different use cases. When you think of fixed income broadly, either two use cases are the current income and then some total return performance in periods of stress. Given that this is in the very front end of the curve, this is very helpful for investors who want to allocate a certain amount of their short-term reserves into a higher yielding strategy that has some downside protection because of its duration exposure. However, this is not a money market fund, so investors that are looking for that dollar NAV certainty at any given point in time need to know that this is not a money market fund. So there is some NAV variability, but for that, investors are compensated with higher yields and some downside protection. We think that this is a really good supplement to a cash allocation within an investor's portfolio. It's a really good supplement to short-term reserves in an investor's portfolio that gives them that additional income, that gives them that additional protection while their other parts of the portfolio are moving with the markets.
Fantastic. Well, we're going to have to leave it there. Arvind, it's been a pleasure having you on the show. Thanks so much for your time.
Thank you, Sumit.